Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have Yuri Khodjamirian. He is the portfolio manager for the Tema Monopolies and Oligopolies ETF, ticker TOLL. A fascinating product, extremely well thought out. I loved my conversation with Yuri. He talks about how they go about picking the certain companies that sit inside their ETF. We talk about portfolio management techniques. We talk about risk management. We talk about diversification. And Yuri has a lot of great information. And I think that you will really enjoy this conversation with Mr. Yuri Khodjamirian. Yuri, welcome to the show.
Brad, thanks very much for having me.
Sure. So can you tell everybody before we get started just about your background and how eventually you got into the position that you are today?
Yeah, absolutely. I guess I started my career in finance and investing back in the depths of the financial crisis. So my first job was July 2009. I actually applied for lots of jobs in the middle of the financial crisis. Had a job offer from a big bank, which I won't name, and then basically said no, and kind of regretted it immediately because on Friday, Lehman Brothers went under and pretty much the whole financial world ended. But I was determined to get a job in finance, particularly investing. I was obsessed with the stock market and picking companies. I was reading about it all the time. And so I applied, and I got quite fortunate to end up at a place called Monopolies Asset Management. They were kind of a young boutique, started in 2002, spun out of a big asset manager, and very focused on kind of good long-term fundamental equity investing. And so I started my career, as I said, in July 2009, in the middle of the financial crisis, on a long-short fund focused on picking stocks across the globe. And I worked my way up basically as an analyst for about 4 or 5 years, applied the trade, and then got promoted to run a fund. So for about 6-7 years, I ran a UK income fund together with my old colleague and co-manager. And we basically, it was a pretty successful fund. We produced good numbers for our clients. And its peak, it was about $2 billion fund. So that was kind of my training in finance, really one place, focused on stocks. And then I left Majetti, and I got, I always really liked entrepreneurship and kind of focusing on what I would call kind of trying to build your own thing and your own culture and all these kinds of things. Majetti was very much that kind of thing. When I joined, we were 20 people. So if you sort of needed anything done, you had to do it yourself. And so in that entrepreneurial journey, after I left Majetti, I met our founder, Moritz, who was starting Tema ETFs. And so we talked a lot. We connected on a lot of things. And I just felt it was kind of the most exciting place going on in active management, and specifically active ETFs. And so I joined about a year ago. It feels hard to believe it was a year. We've achieved so much. We've kind of launched 5 funds in the market, and we're really trying to pioneer the space of active ETFs, specifically focus on really interesting long-term structural themes. So that's a little bit of my background, how I ended up where I am.
No, that's great. It's actually quite similar to mine, although I didn't run a credit fund. I did run a long short fund along the way, and so it's interesting that we took kind of a similar path to get to a similar place. Before we jump into all the fun stuff about the strategy and the ETF, I always like to ask, what about your hobbies? What do you like to do when you're outside the office, when you're not running money?
Great question. So I like exercising quite a bit. Used to do CrossFit. I think it's really important. I wasn't the sportiest kid. I picked it up much later in my life, and I just realized how important it is to kind of support your, if you've got quite a cerebral job, which investing is, you've got to have a pretty sound body of which your head sits on. So I do quite a lot of that. And then I know this is going to sound extremely lame, but probably a lot of people you meet here in terms of investors, they're just obsessed with investing. I mean, basically every waking minute I can, I spend time reading. I read a lot. I try to read as widely as I can because I think it's quite important to read lots of things like fiction books, philosophy, all this kind of stuff that may not seem immediately relevant to the job of investing. But I think the wider you read, the more interesting things you come across. And I think a lot of the best insights you can have are where interesting connections are made between fields that might look completely separate, but actually, somehow get connected. So I do that. And I think it's kind of that's pretty much how I spend my time. I just had a baby boy as well. So that's also actually a lot of my hobbies are going out the window rapidly, taking care of him.
Yeah. You'll find that eventually the sports, once they start doing sports or other things, that then will take the majority of your time on the weekends as well. But good for you and congratulations. I did a short stint of CrossFit and was in the best shape of my life, and then started working too much and got out of it. And finally I brought myself back to exercising again, and I feel a lot better.
But it's so important, right? Like it helps a lot. I mean, people will say this about CrossFit. It's some of it. It just becomes addictive, right? And then you feel really terrible. And what did they used to say? Habits take about 60 days to form, right? That's the official statistics. So if you can hang on there for 60 more days, you'll be back on it. And this is what I'm trying to make sure I stick with that. So never drop within the 60-day window.
Yeah, I get messed up like when I start traveling a bunch for work, and then I fall out of it, and I just do a bad job of if I go to the hotel gym and I'm like, they don't have everything I need, and I'll make an excuse, and then I'll fall out of it. But I've been trying to do a better job.
It's that motivation, right? It's like with a lot of things in life, like you got to find what motivates you. For me, it was really what I liked about it is that you just show up, right? And you just, because you're addicted, you make that decision, you show up, and then you don't really have to do anything. Everything is kind of laid out in front of you. Whereas a hotel gym is just an excuse to go to the bar, right? Instead of just spending time at the gym.
Right. That's right. So we're here to talk about Toll today, the actively managed monopolies and oligopolies, or ETF. Before we get into the strategy, can you define some of the barriers to entry that would classify a company to be in a monopolistic type position?
Yeah. So basically, we monopolies are kind of interesting beasts, right? A lot of people associate them with moat investing, but I think what we are trying to go for is probably like a harder, more strong definition of what a competitive moat is. Almost a lot of the companies that we define as monopolies, the moat is I would even describe as contractual, right? Like it's so ingrained in the way this company's industry structure is built that it's written in contracts. And in many cases, it actually is in the case of infrastructure and some of the companies that we invest in. But if you sort of try to dissect it, I think there are kind of 5 key sources of competitive advantage for monopolies. I think the first one is non-replicable physical assets. I think, the more the world is moving to digital, the more people forget that actually physical assets are, what the makeup of the world, and digital is sort of infinite, right? Whereas physical is finite. And I think a railroad's a perfect example of that. There are 6 Class 1 railroads in the United States, which is the large ones. There used to be hundreds or 180, I believe, in the 1920s. We've gone all the way through mergers and bankruptcies down to 6. No one's ever going to build another railroad in the United States. It's just going to be impossible. The permissions, the cost is prohibitive. And so I think that means that you have this asset that cannot be replicated. So that's kind of group number 1. Group number 2 is a classic kind of network effects. I think essentially is every user that gets added to the network creates more value for everyone who's already a member of the network. Social media doesn't fall into that. And I'll explain why in a second when we get on some of the other topics. But I think things like financial exchanges is a perfect example of that. There's regulation around it, but also liquidity begets more liquidity, and more people trade on a venue, the more valuable it is to other people. Then we have high switching costs. So, places like medical devices where switching some of these in between competitors is almost impossible. It's prohibitively expensive in terms of time and training. So that's a really good example of that. And then regulation, as I said, many of the monopolies are semi or quasi-regulated type businesses, whether you think about airports or actually toll roads like the ticker TOLL. There's a contract, the concessions often run 70, 80, 90 years. So this is the kind of horizons we're talking about when we speak about monopolies. And lots of things can change in the world of other types of companies, but they're sitting on this concession and they'll continue to do that. And a lot of the stuff is written into the contract. So that's the kind of regulatory part of it. And then the final bit is kind of economies of scale. So here we're talking about companies that have essentially created so much scale that in the end, they can produce the marginal cost at which they produce the product is really low, and therefore no competitor can produce it. And a great example of that is semiconductor manufacturing, right? Where you have to reach a level of scale. And in this case, we're talking about scale in the tiniest amount. I mean, I don't know if you read the Wired article about TSMC, but he goes and visits the fab and he calls it it's like seeing God. I mean, it's essentially, and there they produce so many transistors that it's more than every factory has produced of anything ever in the history of mankind. And it's kind of mind blowing, but that's the kind of scale that you need to produce transistors and semiconductors at good cost, in which case you beat your competition. And so each one of these is, as you can see, kind of draws very strong competitive advantage. And sometimes you have companies that have both or a combination of the two where it becomes particularly powerful. Perhaps sorry, go on.
No, go ahead, please.
No, I was just going to say the one thing missing from that, which a lot of people often associate with most, is things like intangible value. And for us, that's just too weak of a reason for competitive advantage. That can be broken much easier than people think. And I think that's a really important point to mention as well. What isn't a monopoly?
So what do you think generally creates this advantage? Is it time? Is it first to market? Is it combination of both of those things? How do these things come about, I guess, is my question.
I think that's a great question. And it probably hits at the heart of why, we get often asked like, aren't monopolies really evil? And surely it's a bad word. But I think the point is to actually look and study monopoly and understand why the good ones, at least, have arisen and why they exist today. They exist today because they produced, in many cases, what we call a mission critical product. So it's really valuable to the consumer of that product, or it was over a long period of time. And over time, this monopoly has created a lot of customer value by providing this product. So take the example of Visa, right? I think there's no dispute that MasterCard and Visa, between them control about 84% of the kind of network's payments business. That is a duopoly if there ever was one. But Visa has created an incredible amount of value for everyone in the ecosystem. Start with consumers, the ability, people forget this, right? That you can just walk into a store and pay with this card and it's instantly accepted. Visa is accepted, I think, in something like 140 countries. And there's only about 150 countries in the world. So it's ubiquitous, right? And it's just created this value for consumers and for merchants as well, like to be able to accept payments safely without fraud. All of this stuff they've created, and all they do is take a tiny little, as we call it, toll, right? And so that's why I think a lot of these other sources of competitive advantage all come down to this kind of thing where if you're a company that provides a mission critical product for customers and has provided a ton of customer value over time, that's the kinds of businesses that over time will morph into these sources of competitive advantage and then create value for consumers. And it goes across all of them, right? Railroads have created a lot of value by moving goods around. That's why it's consolidated as well. If you look at the stats, even though there's only 6 railroads, actually pricing continues to come down in many ways in terms of real terms. And it's a very competitive industry against things like truck. I could go on with lots of different examples, but I think the key point is mission critical, lots of customer value, creates each one of these 5 different types of competitive advantage that then creates the monopolies that we see today. So that's why we think they're not bad, right? They're not evil because they've created this value for customers.
Yeah, no, I agree with you. I think I looked through the holdings. We can talk about the holdings in a little bit, but these are not necessarily evil companies. They're long-standing quality companies that have significant amount of scale. And kind of staying on that, these companies that have gotten so big and have scaled so widely, how do they continue to create shareholder value, right? All we hear about now is tech, and growth, but there's a lot of shareholder value these companies still deliver to investors. And, how do they go about doing that in all of your research by looking at them? I'm sure a lot of them do it differently, but.
Yeah, look, I think there's, I always think of shareholder value as kind of two, so defense and offense, right? In terms of defense, a lot of these companies and why we really like them and why it's really important to pick the right monopolies. They don't gouge pricing. They don't rip off consumers. They don't exploit their monopolistic position. Instead, they take some of those profits and reinvest it in constant innovation. So all of the companies that you'll see in the holdings and the ones that we really like are ones that are sort of not resting on their laurels and milking their advantage, but instead are constantly reinventing and reinvesting. You take a big bet within the fund is information service companies. And right now what they're doing is going through a transformation in terms of AI. And people kind of think about NVIDIA when they think AI, but actually they should be thinking about companies like Moody's that have enormous databases that are proprietary. Moody's has the biggest database of private and public companies in the entire world. That data is just beautiful for artificial intelligence to be used over it as a feature and a layer. And Moody's is investing heavily in that. And that's the kind of thing that we want to see, right? Creating value by playing defense and investing in your business. That's part one. And part two is obviously these companies, because of their strong competitive position, this highly recurring revenue base, a lot of this contractual kind of safety that's written into them, they just have pristine financials and often have very high returns on invested capital. And as we all know, return on invested capital is like investors and shareholders' friend, right? It's essentially like the easiest way to make money in the market is you let companies create this value through high returns and keep reinvesting those returns over time and compounding. But I think it's very, very important that quality often in the market is well known. But the reason why Monopoly is such a good investment is because of the durability of that return and that quality. All our time is spent understanding that durability. And I've talked about the kind of 60, 70-year concessions. That durability creates a kind of a way for the fade not to ever happen, because the market is very conditioned on returns to come back to the cost of capital. And for these companies, this doesn't really happen. And the market just cannot price this properly. And that's why you see share prices of these companies go up over time, because they're constantly kind of beating expectations of the fade in the market. So what I'm going to say is that it's not enough to just buy high ROIC companies. What you need is ROIC companies that have durability over time.
So can you talk about the process for identifying securities that you're adding to the portfolio? I'm sure there's a screening process and some fundamental research that goes into that. And so can you talk about that process a little bit?
Yeah, of course. And I think this hits at the heart of what we're trying to do at Tema. We're really focused on creating a kind of a pristine thematic universe for the companies that we look at. And if you look at lots of our themes, Monopolies being a good example of that, it's not easy to index or to screen for these companies, right? Like if I told you, give me a list of monopolies, I mean, it's actually quite difficult to put it together. There's nowhere. I mean, market share is one of the hardest numbers to find for companies. But even when you found it, is it really a true monopoly? Does it have that position? What's the competitive dynamic? And so you really need a kind of an expert, a person who's really spending all of their time thinking, okay, what is the universe of monopolies out there? There are definitions in our prospectus about what they are, but that's the main name of the game. So that creates your thematic universe, which we call a pure thematic universe. It purely expresses the theme as it's written on the name of the fund. And then we apply good old-fashioned fundamental equity analysis, which I've been doing for well over a decade, basically thinking, okay, what are the best 30 companies I can come up with in this universe? There you might use some screens, for example, looking at balance sheets or other metrics. But really what we're doing is good old-fashioned fundamental analysis. I narrow it down usually to a research set of companies, and then we apply what we call kind of the 4 pillars of our investment process. So we look for companies that have strong operating bases, solid foundations of their businesses, good balance sheets and cash flow generation. And those are really, really important, those 2 factors. They're really the reasons we don't invest in companies that fail those 2 first tests. And then we think about the upside. We think, what is the valuation case here? And in my world of monopolies, often some of these companies are a little bit richer value than the market, and you need to really build a really good, solid valuation case. And then finally, what is our edge in this particular stock and investment? And that's a really difficult question fund managers often don't ask themselves, right? And so we force everyone in the terms of the Tema process to ask that. If you meet all 4 tests, then it's a security that can be part of the portfolio and enters the investment. And that's the kind of work we do. It's a lot of fundamental work, meeting companies, talking to them, building financial models, working with, reading the conference transcripts, all of that kind of good old-fashioned fundamental analysis.
So by the time you're finished with your screen, what does the portfolio look like in terms of number of names? I think you might have mentioned it. Is it 30? Did you say that?
We try to aim for a conviction portfolio without taking excessive risks, and we can talk about risk management, which is a key tenet of Tema. But we try to aim anywhere around 30, 35 holdings. I think where you can express clear conviction of the portfolio. I don't think we'll ever go above 50 or 60, but there might be cases where that happens. We won't all go below 25 holdings, but so that 30 to 35 is a pretty sweet spot for the funds.
And how often are you adding or removing names from the portfolio and rerunning the screen?
Yeah, great question. Because obviously, once you've identified a monopoly, surely it's a monopoly forever. I think valuations change. We're very cognizant of the valuations of some of these companies. I would say you probably would expect the turnover of the fund to be anywhere between sort of 15 to 20% a year, maybe a bit less, maybe 10. For some of our other funds, it's higher. I think that a lot of that has to do with, we build our thesis and investment case, and if it plays out and we feel that the stock is fully valued and the potential has been expressed, then we'll sell it and replace it with new ideas. And I think that's really important, right? Because you want to constantly have competition for capital in your portfolio. So you have your thematic universe, which runs in the hundreds of stocks. And are those the 30 best monopolies out there at any particular given point in time, and the 30 best valuation cases that you can put together? So we do that, and then we do quite rigorous risk management. Sometimes that means you might chop and change names if there are issues that arise. So we watch a lot of risks very, very carefully, and that can lead to a sell as well.
Well, let's talk about that, because it was one of my questions on the list, but it was a little lower. How are you? One of the pillars obviously is risk management. So are you looking at risk management from a valuation case? Is it from a bad news case? Is it technical? Or how are you guys defining and employing risk management within the portfolio?
Yeah, it's extremely important. And I think the reason we've made such a big deal about it is because a lot of people in our industry don't take risk management as seriously as they should. I think it's definitely not great in a lot of active funds, especially active ETF funds. And we've made it a big deal. And my philosophy on risk management is kind of the philosophy of jumping out of a plane with a parachute, right? If you jump out of a plane with one parachute, your chances that the parachute doesn't work is like 0.01%, right? But if you jump out of a plane with two parachutes, it actually multiplies the probabilities, right? So 0.01 times 0.01, which is a much, much smaller probability. And that's how we try to think about risk management. Like multiple layers of risk management means that you're always, you're reducing the probability in a multiplicative way. So it starts with the security selection, making sure that, for example, things like balance sheet are solid for the companies that we invest in. And I'm talking about balance sheet in the broadest possible sense. And I as CIO, I obsess about this because getting the balance sheet wrong on a company means a permanent impairment of value of the equity. You're never going to get it back. We've seen that with many examples. I mean, WeWork being the most prominent example this week, but it happens all the time. At Silicon Valley Bank, get that wrong, you never get your equity back. Profit warnings, margin resets, you can get your money back. And so we're just always really cognizant of that. And then you have kind of the portfolio construction process, which is an interesting idea that we've put together, which is kind of having 3 conviction tiers of position sizing. And that controls your highest kind of position size, but also make sure you don't have the behavioral biases that risk management often needs to kind of counter. That makes sense. And then we have lots of different checks. I sit down with the fund managers every 2 weeks. We discuss the portfolio. We make sure, basically the worst thing is taking risks that you don't think you're taking, and making sure that we know all the risks we're taking, and 2, making sure we're happy with the risks that we're taking. And that's the kind of philosophy that permeates. And then we have a lot of the modern kind of tools in terms of risk models to try to understand how these portfolios will behave in different environments. Remember, we're running 30 stock portfolios, so they can move around. And so it's really important to know if another crisis happens, what happens to your portfolio? How do these stocks behave? And we run all kinds of analyses to do that every quarter to make sure that portfolios are sound.
Yeah. So when you briefly touched on weighting, how are you going about weighting your 30, 35 holdings inside the portfolio? Are you doing that? Is it via market cap weight? Is it, company size, or is it you guys deciding where you're kind of placing chips on the table? How are you going about your weighting decisions?
Yeah, so one of the first things I did when I joined, before we launched funds or hired any portfolio managers, is sit down and think about the investment process. And one of the key things that we wanted to focus on, especially with this idea of risk management, is position sizing. And if you look at the literature, and I spend a lot of time reading and talk to a lot of market participants, you realize a couple of conclusions. First, a lot of people don't think about this problem at all, right? They either go for a very mechanistic approach, or they go for a completely free for all approach where the fund manager decides. And two, if you actually read the literature, you realize that there are just lots of really interesting rules that show how a good portfolio should perform in terms of its sizing, and what are some of the pitfalls that can happen. And there's a lot of behavioral science behind this as well. And so we did all of this work. We talked to like multiple participants in the industry, read a lot of academic literature, and we came up with a process that's a little bit of a middle ground where we have 3 tiers of position size. Moving between the tiers is a conviction decision. So we have the highest conviction, medium conviction, and sort of entry position as well. And that means that you have a minimum position size, which is very important from a behavioral perspective. People often have little positions that don't really impact the end investor's outcome, but are there because the fund manager feels comfortable. You also have a maximum position size, so you don't take overly confident risks as well, and keeps you cognizant. And then you move up in between these, you make trades that are substantial trades, if that makes sense, rather than sort of moving little tiny bits that don't really impact the decision. But then this framework works really well, and it also has an active systematic rebalancing approach where you essentially, the fund manager makes the decisions, but they're always thinking about rebalancing at the right time rather than rebalancing in a mechanistic way. And this is what we found. We've been testing it in the market in lots of the models, and it works really well. Fund managers like the structure around it because it gives you this kind of risk managed approach. And the reason for this is fundamentally active management is really good in general. The good fund managers are good at picking stocks. They're not that good at sizing the positions. So you need some rules and guidelines on sizing to make sure you harness that stock picking alpha in the funds.
So if you have a high conviction position and that position works for you, you're then going to go through a rebalance to pull that back, and that's done randomly, quarterly, systematically. Maybe expand on that a little bit more.
Yeah. So exactly. You don't. It's kind of like guideline rules, right? So if it's drifted above the weight that it's supposed to be in the portfolio based on its conviction, the highest conviction one, that is a marker for you to be like, okay, this position has gone up. Is the risk reward still valid within this portfolio? And what you find is the rebalancing is not at a set point in time. It's more of a sort of, I would call it like event based, but anywhere between 3 to 6 months, you want to be looking at that and thinking about that. That is the optimal rebalance frequency, by the way, which happens in the literature. So what we do is every quarter we sit down, we look at it and we say, okay, has this, I sit down with the fund manager and be like, has this gone above what you think is the right risk reward for this particular stock? And you make that decision at that particular point in time. It's active management, but within kind of what I would call guidelines. So it's different to a completely systematic approach where you have to rebalance every 6 months. It works well because sometimes you don't want to be doing, selling that particular position. Equally, though, it counters the idea that people should let their winners keep running, because in truth, if you look at the most successful fund manager, the generation of alpha and really good ideas is about an 18 to 24 month life. And so you don't, and I think that's important to say, because you don't want to be scaling positions up at the time where the idea is probably past its best point. Does that make sense?
Yeah, no, it makes a ton of sense. So kind of last question around risk and portfolio would be, how are you diversifying the portfolio in terms of industry or sector concentration? Is there guidelines around, how much you'll put in a specific industry or sector?
So all the portfolios are built bottom up. So I think it's very, very important that the individual equities stand on their own ground and are ideas that the fund managers really like and want to own. And then what happens is obviously that spits out a pie chart of industries, geographies, currencies, market cap bands, you name it. And what we do is we just monitor those extremely carefully. And that is where the CIO oversight, comes in, where we sit down, we talk about it, and we say, okay, you're 20% in financials. Are you happy that you're taking this kind of risk at the top down level? So it's a kind of security selection from the bottom up, risk management from the top down. And I think that works really well, because all it does is it means I pose pertinent questions to the fund managers and ask them, are you sure you want to be taking this risk? And also it illuminates risks for people. And we cut the portfolios in every way you can imagine, and including proprietary ways, different subsector allocations, different risk profiles that we've identified, interest rates, macro environments, you name it. And it's always the conversation is, hey, your portfolio is too exposed to, it's correlated to the long bond yield. Are you sure you want to do that? Maybe you want to diversify it a little bit. And that's what we're trying to do. But ultimately, the security selection comes from the bottom up level. So it's more of a question after you've picked the portfolio than it is in the process of picking the portfolio.
Yeah, that makes a ton of sense. So when you're talking to potential investors or, RIAs and the like, when you're looking at their model portfolio construction, where are you recommending that Toll fits inside of existing model portfolio?
Yeah, again, a great question. Look, I'm going to give you it's thematic investing. So often people think, oh, that should be in a satellite allocation. But the truth is, these are really good, high quality, long-term, durable businesses. And in many ways, switching a core allocation or part of a core allocation, especially, remember, the Toll portfolio is a global portfolio, so it invests overseas as well. It sort of high grades your portfolio in terms of quality and long-term durability of it. And so we're often speaking to clients, and a lot of clients are very open to this idea that, hey, this actually makes a ton of sense, right? I've seen a lot of success in terms of people taking US exposure and adding a quality filter or factor. If you look over a very long period of time, going back to the 1920s, and there's a great paper by AQR where they analyze different factors. A quality factor in equities, global equities and US, is one that works in almost every single environment over a very long period of time, in and out of sample. And so we think that is that. And this is a very quality portfolio, but this is a subset of quality portfolio that has a lot of durability built into it because it has this innate building ability to kind of keep fighting the fade of returns. And so we're often having these conversations where we're saying, you own SPY, you actually own 7 stocks, right? Let's be real here. 30% of that portfolio is those 7 stocks. Are you a stock picker? No. Okay. Should you be thinking about diversifying your allocation to something else? How about some international? How about high grading the portfolio? And we go down those 2 avenues, and that's where Toll fits.
Yeah, when I was looking at kind of the holdings, portfolio construction, everything you guys do, to me, it seemed like, large quality, large value, like that sleeve of the portfolio made a ton of sense. So I kind of positioned it that way, or I would position it that way. But Yuri, this has been really fascinating. I really appreciate your time. Before I let you go, where can people learn more about you? Where can people learn more about Tema and your ETFs?
Yeah, so the best place is obviously our website. So if you check out temaetfs.com, there's a ton of information. I think we've written a lot about different things and our different themes. So in the insight section, there's lots of interesting things, and there's the fun pages there. You can check out Toll, TOLL. It's the ticker, and there's some of our other funds as well, which I think are really unique and interesting themes in terms of the purity of expression of the theme and just the level of expertise. People with 20, 30 years of experience investing in the market with a really consistent investment process, and that's where you can find the information. And look at our funds.
Again, Yuri, thank you so much for your time. It was a pleasure meeting you.
Great, Brad. Thanks very much for having me.